The market has officially hit its summer peak, and we are beginning to see a decline. The Fed has signaled it is not dovish, it is hawkish, and we are now starting to see an accumulation of listings on the market. What does it all mean? We're going to get into that in this month's market read. All right, guys, welcome in. We're going to walk through this month's numbers slide by slide like we typically do, and of course there is a informational read for you guys in our market report. I think it's almost 40 pages this month that goes across all the market segments, local, national, digs into the land market. We look at new construction heavily. It gives you a pretty good idea of what's going on. That is available at deepdirt.co. Go download it. Hopefully you find some value in that. With that, let's jump right into what we have going on. One of the big numbers we have been tracking is this divergence in the market, and it's been widening over the years. The appreciation gap. One of the conversations I like to have with anybody when they ask me about the real estate market is the market good or bad? That's the typical question you get. How's the market doing? I like watching appreciation. Affordability is a big conversation right now, and it's useful to remind people that just because you haven't seen appreciation the past month or 12 months or 16 months, this market hiccuped heavily 2020 to 2021 and right into 2022 before you saw the interest rate increase in December of 2022 and that march upward, which slowed the market pretty heavily. During that time period, though, the interesting dynamic that has emerged is if you just did a 4% simple compound on resale versus new construction in terms of appreciation. So essentially, what should appreciation actually be, or the median sale price of a house be, versus what it is? And resale has consistently shown up above that line throughout all of the bubble, and then once it cooled off and we started moving forward again, the ups and downs with the Fed, which we'll talk about here in a minute, it has been pretty consistently above the appreciation line. There's a lot of factors for that. New construction started losing ground in late 2024 going to 25, and I started actually tracking this because it does tell a tale of two different markets. And what's interesting also is even when they go to sell their properties, a builder versus a person who owns their property, they're under different types of pressure. You have one that is fighting prevailing inventory wins. It's fighting probably higher financing costs if it's a local builder. Even if it's a national builder, it's just capital deployed that they're not seeing a good return on, which ends up hurting gross margins, shareholder value comes up in the earning costs, so then they have to peel back what they're doing. Essentially, there's more pressure on the new construction segment than there is on the resale segment, and we're seeing that show up heavily in the appreciation read. So this gap is now widened to $119,000 in difference of appreciation. And remember, that does not factor into it what the builders are offering as incentives. So that is something for us to keep an eye on as things move forward. I'll also emphasize here, and I'll probably say it again 4 or 5 or 6 more times, this is a very regional real estate market. We are not in a market where a national economist can say, well, the entire housing market is doing this. You could take national numbers and overlay it, but when you start drilling down into the different areas, it's a tale of different cities. I mean, down to local municipalities in some areas where you're seeing certain zip codes outperform other zip codes. So be mindful of that when you're looking at your data. Be mindful of that when you're looking at any kind of report out there, that they're differentiating and they're not just taking a general national number and saying this is the number for the whole market, because most often it's really not. So my market is a triangle. It's a pretty good indicator of what's going on around the country in a lot of different markets. We're seeing that same type of squeeze. New listings are, of course, growing year over year, up 5%. However, month over month, they've declined. That is seasonally normal. We see a downtick going into our late summer months as people go back to school, come back from vacations. Under contract sales down month over month, but up year over year. And then your closed sales are heavily down month over month, up year over year. I anticipated that last month and kind of called that. I figured July would be a little bit light. I think August is going to be the same story. I won't get ahead of myself here. I do think that we're going to see a decline in the overall market just based on some of the the consumer fear index is what we're seeing. Median sale price remained pretty sticky year over year. It declined, of course, month over month a bit, 3.5%, but year over year, still at that 0%. Inventory for sale continues to increase. We're now up to 8,390 units on the market, which brings our months of inventory to 3.7. That's a almost 9% increase year over year. This number doesn't stress me out like it stresses everyone else out. I do think we start paying more attention to inventory to see where it ends up. It's becoming a higher for longer situation. I'm starting to have doubts, and I'll say it now. I haven't quite nailed into what I think's actually going to happen. I'm starting to have doubts that we're going to see a lower interest rate for a long period of time. There's just too many headwinds for the Fed to skate into to really justify bringing that rate down. We'll get more into that here in a minute. I just don't see it happening. So I almost am curious to see what the months of inventory will look like a year from now versus what we see at this point. Again, another good indicator, original list price percentage received, still pretty high. You saw a little bit of a decline. And then absorption rate. This is, of course, one of my favorite metrics to track. To me, this is the whole supply versus demand conversation. And you can see that year over year, we saw a pretty healthy decline, 10.5%. It almost mirrored the month over month at 10.8%. So I think we're seeing some of the hope that was in the market of, buy a house, the rates will come down, you can refinance. The consumers are starting to see that that's not going to be the case. And then, of course, you have the last conversation from the Fed chair, and he made it pretty clear they're really concerned about inflation, and that's what they're going to go fight. All that being said, I don't see a lot of these numbers getting shaken up in the next several months. Now, again, this is resale, so let's go ahead and jump into new construction. New listings up again, decline year over year. The reason we're seeing these declines on new construction is it is a different market than your resale from a supply standpoint and how builders typically put out their inventory and how they pace their starts. A lot of national builders, and it was taken on by a lot of regional and even some local builders tried this, especially during 2019 going into COVID. You had all the supply issues from 2020 and 2021. Everybody was marching towards something called even flow. Even flow is where and it's different scale, different size for every builder. They did it by region, they did it by city in some cases, wherever their market sales area was. But essentially, you're selling a property every day. Or you have a certain number of starts you want to do in a time period and a certain number of sales you want to do in a time period. So you have this even flow number where you're essentially maxing out the number of turns of inventory that you can get in your business on an annual basis. Now, they can dial that up and pull it back by doing pre-sale or spec. A lot of your local guys prefer pre-sale because the banks like pre-sale because it means there's a buyer attached to the other side of it. It's less risky. Spec inventory is just short for speculative inventory, meaning that they are guessing, hoping that a buyer will show up to buy whatever they put on the ground with all the styles and finishes of the property. Larger builders, your nationals, are able to do this at scale. They have more levers to pull or more dials to turn to get that property sold should it not move the way they want it to. The local guys typically only have one thing, and that's price. They really can't fight on too many other fronts. They don't have their own lending or financing arm. They can't offer major incentives on rate buy downs. They don't have that power that the national guys do. So when I look at this and I see new listings, under contract sales, closed sales, I see those numbers going down year over year. If you look at closed sales, you can say, well, that's a major drop off on the closed sales year over year. I'm always hesitant to say that it's a major indicator in their market because they control so much of their inventory and how it moves that they will dial that up and dial it back at a moment's notice. And if you read their earnings reports, which we do, and we put that in the land desk for anybody in the Platinum membership, we actually just did a big one on LGI, and it was fascinating to see how much they turn those dials to make these numbers go up or down. Now, another interesting thing on this breakdown is the median sale price. You see that it stayed pretty sticky year over year, but they still lost 4.2%, not including their incentives that are baked into these things, which I think is always a good thing to keep an eye on. You saw inventory decline. Again, they have more control, I say artificial constraints somewhat over their inventory to intentionally lower what's available on the market. They will do that in times of a slowdown, which they are seeing right now. I'd be cautious on seeing that this is a good thing. I think there's a supply shortage at the moment. So if they dial this back too much, we're going to whipsaw in the other direction and essentially have not enough inventory, which then will increase prices. And we're going to be back in the same game that we've been in for the past several years. Their offer list price or original list price received stayed strong year over year. Absorption rate, pretty consistent. Again, they just have so much power to juice the market and push sales forward if they need to, or pull them back. Now, where you have to watch these national builders is on their earning calls and on their either 10K or their quarterly reports. You need to go look at their gross margins. That will really tell you if they're taking it in the teeth when it comes to incentives. And I'll go ahead and break it for you guys. They are getting punched all over the place. They're seeing some relief, but every report I've read that has come out recently, they are all predicting higher for longer. So they are anticipating needing to continue to have those extra incentives that they weren't baking into it for a longer period of time, which means that you'll most likely see new listings continue to decline because they're not going to be putting as much on the market. They're going to slow down starts. They're going to slow down takedown schedules, and they're probably going to push a few development projects. If you're on the land side of things watching this, they're going to start pushing those into 2027, late 2027, maybe even 2028 as they dial back their start numbers. They won't need as much on the lot front so that they can continue to grind away with their current build cycles until they see some relief in this sector. I just don't think we're going to see it for a hot minute. This is just an overlay for new listings under contract and closed sales. You can see new listing inventory is bumping up, but when you look year over year, you see a typical increase and then a decline. The same with your under contract and closed sales. It is the first month all year that under contract and closed sales both fell below their seasonal baseline. That's a new one. We want to keep an eye on that to see if that continues in for the rest of this year, or if we believe that, it's not so much market pressure, it's just the seasonality occurring in terms of their decline. I again have a sneaking suspicion here that this is more of a conversation around the pressures of the market. We're seeing compression happening in real time. Price is softening, but I mean, you look at the band that these numbers are in right now. We see it go down into the 380 range in this point right here, but then boom, we're way back up here. I think that this was hope right here. We believe that the rates that are being put out there are going to go down later this year. You had the president talking about getting rid of the previous Fed chair so that he would lower interest rates and get that done sooner. It doesn't look like that's going to be the case. We could all get surprised here. You never know what's going to happen. But right now, all signals point to a rate pause, if not a rate hike, in the next several months. Months of inventory, both segments, again, running hotter than we've seen it. I think new construction will continue to taper as it goes on. They like to hold it pretty steady. The other thing that this does not show is some of the off-market detailings of the new construction market. They often have, and this is where I like to call it shadow inventory. I don't think that they really have heavy amount of incentive to continue to put more product on the market. So they used to wait until around rough ends to begin listing their house. They like to have the walls up, drywall completed, before they would actually list the property for sale. And I mean, 2 years before that, we're talking about 21 and 22, you had wait lists of buyers that you would have to do a mass blast everybody saying, hey, you're number 2 on the wait list. You now get to purchase one of the available project or homes that we have built. I think you're going to see that taper. How much does it taper? I think they keep us in that 3.5 to 4 months of inventory. I don't think they want to get too much further below that amount. Resale is the one that it continues to grow. I think that market, you're seeing buyers become more picky about the properties that they're purchasing. So deferred maintenance, if you're a seller, no, not something you can get away with anymore. If you need a new roof, if you need an HVAC system, if you need updates internally inside of that house, whether it be paint, it need new counters, cabinets, whatever needs to be done, buyers are now much more picky and they are expecting those things to be completed prior to the purchase. They just have too many choices on the market right now. So be mindful of that when you're looking at putting your home on the market. We are seeing that resale side slow down just enough, and the inventory continue to build, and there's really no sign of it slowing down. So this is a really interesting breakdown of how long a listing can sit. It goes back to 2005. I'm a big fan of going back, and you see this giant drop off right here. And I believe this is a calculation change on behalf of the MLS. I haven't dug into it, but that's my first guess when I see something that drastic shift year over year. Nothing major occurred in that year other than potentially they shifted how they do that data. And then you can see it pretty much stabilized throughout here. We saw a pretty heavy dip here in 21. And these are those peak months. So to me, these represent your floors. Late 2022, we saw the interest rates begin to go up. And then you see here it is in 23, here it is in 24, 25. So this march upward is telling me that the market is becoming a bit more selective on what it will or will not accept from a potential seller. And it's verifiable data. Listings are sitting longer. So if you are putting your home on the market or you're advising clients or whatever the case may be, it is moving faster. I mean, it is moving slower. So make sure that you guys are pricing that in and making sure your buyers are aware that they have more opportunity. They don't need to make a rush decision depending on the market and location that they're in. But we're seeing it sit much longer than it used to. I like to see how much of the market is resale versus new construction. So this is something I like to track. I've been tracking it probably for over a decade now. And we have seen the new construction share of closed sales has risen to 37.3. And again, original list price received is stuck pretty tight to each other within a point. So not something I'm super concerned about. And if you guys have not joined yet, you should jump in. We have our full report in there. We have multiple people in the rooms doing different deals, putting things together that sometimes you get some advice on a deal, or you can find somebody who wants to be in one of your deals if you're on the land side of things. It's a lot of different tools in there, template libraries, all the different stuff that may bring you a lot of value. It helped cut out a lot of my learning curve back when I started to have some mentors along the way. And that's why I put that together so that you could get in there, see how deals are run. You can get some more information on the market, all the land desk articles that we do, which focus on builders. We look upstream and downstream for different things that may inform the land as well as real estate market. If you're not in there, you should be. There is a free trial on it. So again, if you think it absolutely sucks, then you can shoot it and not be in it. But this report for this particular market update, and every single month when we do one, that will be in that room available for all the members. We also send it out in our monthly email. Either way, you should jump in. There's also a free tier that you can get some of the base models on as well. So all of this is at deepdirt.co. Go check it out. So I like to look at some weird stuff when it comes to the real estate market. I'm trying to find trends. A lot of the stuff that we see has happened before. You have to be cautious that, correlation is not causation. So keep an eye on that whenever you're looking at data. However, some of this is useful for you to keep an eye on as you're walking through the different components of the market. We've talked about this a little bit already. This is important just because we're starting to see a decline in new construction's share of closed sales, 37.3%. It's been as high as 60+%. I think that we'll continue to see this decline as the months go on, partially because more resale inventory is coming on the market, but also because I don't think the builders are going to build as much going forward. I think you're going to see a real pullback. I also like to look at the original list price percentage spread. So this is resale spread versus new construction. We're down to a 1-point gap this month. That's the tightest that we've seen it this year. I think we watched the direction of this over the next few months to see if we're seeing resale having to give up more ground or if they continue to just hold and not sell their properties. Absorption rate, one of my favorite numbers to track. We saw new construction break through the year over year change. It's flat, but this is the first read that we've gotten where it's gone above 0%. They're holding their ground on conversion. I think that's due to the need to move inventory. They have product that cannot sit on their books for extended periods of time. And on the other side of that, you have resale. And resale, as per usual, I think a lot of those sellers are putting their houses out there. If they don't sell, they're going to pull them and they're going to re-put them on the market later. I think that we're seeing two very different markets. And this is where it makes real estate really challenging when you're talking about this on a national level, because so many times I hear a generalized number, and not only is it hard to nail that generalized number down when you look at a certain metro, like a metropolitan area, or you're looking at a certain MSA, but then you need to go inside of that MSA and break up the local differences between the markets. And then beyond that, you have different housing types. You have the new construction versus the resale conversation. It is just so much minutia that goes into these different market segments that I'm seeing more of a divergence on a regional and local level than I've seen in a long time. And I think we're going to see it continue market to market, where so many things have now become urbanized versus not urbanized. And this is going to continue going forward. So your absorption rate changes are a really great indicator of simple economics, supply and demand. Is supply keeping pace with demand, or is demand outpacing supply? And then when you start to see a switch in those markets, it's something to pay attention to. I like to look at the lag in the market. So new listings versus the closed sale. It's holding strong on this. Now, again, you can do the MLS measurement, right? They have the days on market, and it lands you pretty close to the same number, approximately 2 months. So when something goes under contract or is a new listing, we expect to see it close off the books within 60 days. That's approximately the number that we're looking at. So when you have 22 days on market, 30 to 45 day close, and you're typically within that 60-month trend line. This is holding stronger. Whenever you see this stretch, it for me, when I go back to the 2008 data, it somewhat reminds me of the distressed sellers, right? Short sales back in the day, if you were around long enough to do one of those puppies, those are painful. It takes a lot of time. There's a lot of moving parts with it. People became short sale experts because there's so many moving parts, different people involved. The banks had to respond. There's time delay. I mean, it just took forever to do it. So if I see this number stretching, it's one of the indicators for me that we might be having some stress inside of the market, or buyers are having a hard time obtaining financing, or we're seeing them have to do creative financing, different things, or they're switching lenders at the last minute. That's a really strong indicator that there's some funkiness going on in the market. We're not seeing that right now. It's pretty consistent across the board. Price per square foot and dollar volume. This is a fun thing to track for your home market. Again, you have to really niche down into certain parts of the market. In my personal market here in the Triangle, we have areas where it's $400, $500, $600 a square foot. And we have areas where it's $80 a square foot. It's just all over the place. However, when you look at the median for the entire market on the resale side of things, you are around that 210 to 220. That's kind of the band it is operating in. We broke through for a few months in 2025 where it went below that 210 mark, but it looks like it's creeped back up. Be interesting to see if this decline here continues to go down seasonally, or if we level out at any point. We'll keep an eye on that. And then your dollar close volume, resale still is the monster in the market, right? $1.34 billion. New construction is at $500 million, but they're both down from June. Not atypical year over year. We see this decline happening, but we're going to keep an eye on whether or not there's continued declining in the market when it comes to our resale and new construction sales that are happening. Showings to pendings, this is a great MLS number. It gets harder to pin down the more we move to digital because there's just less people going and looking in person. However, I am starting to see some pushback on all of the AI generated listing photos because they are horrendous. Whoever of you that are doing that, you need to cut it out. It is catfishing or house fishing at the highest level. I have seen some stuff that is truly mind-boggling that they are allowed to put those onto the MLS or let buyers look at them. So I think that you'll start to see showings pick back up a little bit because there's nothing better than some boots on the ground to verify what's going on. I do think if you look at the two graphs here, you can kind of see that higher showings to pendings happens with a hot market, not against it. So we are starting to see that decline, which normally means that, we're going to see less showings on houses, because houses will sit longer or the buyers have more choices. They're walking through less properties. Again, something to keep an eye on, but it's not really going up or down majorly here. We're pretty steady. In between 8 and 10 showings, you should have a pending somewhere in that time frame. If you don't, then you most likely have an overpriced property. Of course, from the land side of things, I'm always watching what's closing on the market. I pulled the simple MLS data for this to see what closed through the MLS. However, we typically roll in the Register of Deeds numbers as well for each county. I like to look at all of it to see what's really moving, what's the closed market values on a lot of these deals. The challenge with the land market is it is a long burn. So you can have something that, put under contract 3 years ago before it actually closes. So then the question is, are you looking at a reflection of today's values? Or are you looking at a forward-looking speculative number from almost 3 years ago? A lot of times, you're anywhere from 12 months at a minimum to around 24 to 36 months. Most sellers don't go beyond 36 months. The caveat there is when you have a property go under contract and then out of contract, then back under contract and out of contract multiple times, suddenly it originally went under contract in 2021 and doesn't end up selling until 2027 because there were multiple times that the sellers and the buyers couldn't work the deal out. So the land world's real messy from a data angle, in my opinion. I've seen a lot of people try to corral it, and it's never gone great. The best way to do this is to go into your local area and pull up the numbers using a kind of compendium of things like your GIS, you're using tax records, you're using Register of Deeds, you're using MLS if you have it. There's other commercial tools you can use as well, but those are the best sources that I found to verify and then overlay them to see which one is telling you the truth, or if you have an outlier that's making stuff up. So 223 transactions through the MLS, total dollar volume of $40 million. Median days on market are almost 50 days. What's interesting about land is there's more negotiation. I've often said there's two big negotiations in a land deal. A lot of sellers don't recognize this and they just go in on the first one and then they get burned on the second one. And you can see, of course, there's a pretty heavy difference here in the 49 and 22 days in terms of time on market, different classes altogether. It is interesting to see the difference in list price to sale price for when it comes to land versus resale properties. If you have a seller of land, and I see this a lot, especially with farmers and people who haven't sold a parcel of land, but they've sold a personal property recently, it's hard for them to conceptualize that there's that big of a gap if you don't know what you're doing when it comes to selling land. So if you are going to sell land, make sure you get with a broker or somebody who knows what they're doing. I'm always happy to take a look at it in our market or across North Carolina. We get a lot of questions to come and say, what's the value of this property? What can you do with it? That really makes all the difference, or can save your seller quite a bit of money before they get too far down the road on something. I always think this is interesting just because location is so key. But what's also interesting, because you can see on this side, of course, Wake County, this is our big daddy county right here, state capital and everything. So of course your price per acre is higher there. It's very urbanized, a lot of people around, a lot of money in that area. And you can see how it differentiates going from county to county. What I like is looking at your under 1 acre. Typically to me, these are lot prices for that location. And then you have your 1 to 5 acres and 5 to 10. The jumps in between 1 to 5 and 5 to 10 in terms of value per acre is fascinating. We are seeing higher price points on larger parcels if they're zoned appropriately. I cannot emphasize this enough when we talk to sellers right now. Everybody thinks that because somebody down the road got a certain price on it that they should be able to get the same price. And it never works out that way. There's always different pieces of the puzzle to each parcel when it comes to zoning, it comes to entitlements, when it comes to regulations, usable acreage versus not usable acreage, your dirt. It's so many things that go into it that somebody sees that somebody got $42,000 an acre. And they're like, well, my land's worth $42,000 an acre, but the other parcel was already rezoned for medium density residential or mixed use. It changes the value entirely. So that's why I always say value is manufactured, it's not found. You can stumble into a good deal, but most of the time, the best operators know what they can do with the parcel after they get it versus a lot of these guys who hope that they walk into something and then find value just laying around. You can. It's just, I love trying to forecast the market, but I'm also a big Buffett and Munger fan. So I always go back to, if someone forecasts anything, high probability they're going to be wrong. And I like to take the historical approach to a lot of this and say, okay, what has the market done over the past 20 years? And then I break it down by seasonality. And then I do a forward-looking projection on what I think the market's going to do over the next 12 months and say, okay, here's my band. I do high, medium, low. And then where do we fall at? And you can see new listings have just blown the doors off this whole year, because this is the high side of my band and they are just stacking it up. Of course, there are some things that happened in these time frames with new Fed chair, higher for longer is now here. I don't foresee this changing. My big question mark going into next year will be, how much inventory do we stack up? Under contract sales fell pretty much inside of the bandwidth of where I thought they would. It's starting to trend down a little bit more than I thought. I do think seasonality is going to come into play here. You're seeing it hit a little bit harder. And then closed sales, of course, is just a lag measure of all of this. It's peaking right now on going through the bottom of that band line. So again, new listings, almost 10% above the moderate case. It's the 7th straight month of it running hotter than we thought it would. But again, July is the first month all year that under contract sales and closed sales both fell below moderate, which to me is a early flag of something going on. So supply is still here. It is coming to the market. Buyers are pretty much saying, one, they can't afford it, or two, it's not the type of supply they want. Deferred maintenance, I think that's a big conversation people need to start having or considering when putting their homes on the market. New construction, new listings, again, popped right above the market. I did think there was going to be a seasonal downturn here in the market, and they held more steady. I read, and this is where when you get to forecasting, you can read it right and still be wrong. I had a call here that I thought this would dip down a little bit just based on previous seasonal averages, and it did. It went down a good bit, but then it still was higher than the number I thought it would be at for under contract sales. I thought they would push more incentives and really try to take advantage of the spring market. It didn't quite do what I thought it would do when I thought it would do it. And then we're back within the bands on this side of things. And then closed sales, you're seeing it push, and then we declined in July. So I think that continues throughout the rest of this year. The builders are not going to wait out the market. They are going to push their inventory through. I think the ripple effect is, what do they start next year? What does the next spring market look like? And if they continue to decelerate their starts, if they continue to slow down their side of the market, I think it hurts buyers and I think it hurts affordability, because there will be less choices and your inventory will start getting constrained again. However, builders will do this. They have done this every single time there's been any type of hiccup in the market. They respond according to market demand. Remember in 2020 and 21, when the market picked up, they pulled starts forward that were not projected to start for another 12 to 18 months. They pushed neighborhoods ahead of production schedules. They did more bulk takedowns. They got very aggressive with the market. So they are very market driven. And right now they're anticipating a softer market for the next year and a half. I would expect that to show up here for next year when we do our forecasting, that all of this will decline again. Does that help or does that hurt the market? My opinion, I think it hurts the market. We'll look at the data though as it comes through and see what it really means. I of course like to look at the federal backdrop to everything. And of course, interest rates are just the trailing 12 or trailing 13 months right now, over 6.5%. Last weekly average was 6.69%. We had the Fed board get together, and you actually had 3 dissents favoring a rate hike. We had 0 of that in June. Tells you everything you need to know about the national backdrop or international backdrop that we're operating under. Your housing market indicator from the Builders Associations down to 32 from 34. And then new home sales, again, fell 3.3% month over month. I anticipate that continuing to fall throughout the rest of this year. This picture does not get better as the year goes on. If anything, this picture gets a little bit more constrained and a little bit harder for the market to move forward in general. I like to bring this up every month. This is just to give comparisons. What do we look for when we're talking about these major market issues happening? Absorption rate, seasonal peak percentages. You can see this is 2005, 2006, 2007. We had 2 declining months here, 2 lower, higher highs is what we call it. And then you have, boom, big drop off. We have had lower, higher highs for the past couple of years, 48.4 down to 45. Does not mean that we are seeing a major drop off. It is something to watch going into next year. Again, the housing bubble that was present in 2006 and 7 was built off subprime mortgages. We just don't have that this time around. The months of supply, seasonal floor, 5.1, 5, 5.2, and then boom, 7.3. We've seen a steady rise in inventory, but I also emphasize, and I did this in a recent video we did on the foreclosure shadow inventory rumors that are out there. We are coming off a floor. This is a floor number right here. 0.7 months of inventory is just non-existent at all. So whenever you go from 0.7 to 1.4, you have increased by 100%, right? It is boom, you're massive numbers. But when you look at it in comparison, it's been a steady increase, 1.4 to 1.6 to 2. And then the most recent month, we're sitting at 2.5. So I think that we're fine. And again, I emphasize that a lot of this is regional. I do think we're going to begin seeing softening in the market, more so in certain locations than others that have gotten ahead of themselves and are out ahead of their skis a little bit. So I see this as a cooling, not as a major recession. 18 indicators that show we are not replaying 2008. Now, there are only 8 on this chart. The other 10 live inside of the workbook that I mentioned at deepdirt.ca. You can see on all of these numbers, we are seeing a hodgepodge. And when I looked at the full 18 numbers, I am seeing a hodgepodge, which makes it really fun to try and figure out where is the puck going forward. Yield curve, not signaling currently, structurally safer in terms of your ARM shares. I mean, look at that. 35% of all mortgages were adjustable rate mortgages. We're now around 8% in 2026. It's just a whole different ball game when it comes to interest rate volatility. Your housing index was a peak of 72, class 18. We've just been stuck kind of in the doldrums here at 32, or approximately 30 months under 40. That's just a long time of pessimism in our market. We are seeing real year-over-year negative for 11 straight months for the Case-Shiller. It's always, I watch Case-Shiller pretty heavily. That's a concern. And then we see regional divergence. We're seeing that again. It's just different areas. Tampa, Denver, Seattle, Dallas, Phoenix, they are negative. I do think they're going to normalize and trend back out. And then your home builder equities still trading around the S&P 500. That's a good sign. Pending cancellation rate, it is high, 13.7%, but that's again national. Locally, it's a different story for a lot of different places. And then bank lending standards, I like to keep an eye on. Have they loosened things up? Are we seeing different credit products come to the market? We are not seeing that right now. So again, overall, it is a hodgepodge of signals. There are some things we need to watch at. There's a lot of things that we're looking at, and it is more of a looks fine. And then what I would encourage everyone to do is, if you're not in deepdirt.co or in one of our membership tiers, jump in and take a look. We do a lot of different information on different parts of the country. You can see pretty quickly and use our data to match it up against your data and say, okay, is my market in line with what we're seeing, or are there red flags here that I'm not paying attention to? So one of the things I've heard is that we're going into a real slowdown in the market. And to be clear, I don't disagree with this. I have seen a slowing, and I think everybody was waiting to see how the Fed chair would do in his first meeting. And it's very clear he is looking for inflation before he worries about the housing market in general. I don't think we're in crisis territory just yet. Are we approaching it? I mean, you really had to get a major amount of inventory dumped on the market to get into crisis inventory levels. Doesn't mean that we aren't concerned and keeping an eye on it. We haven't seen major price reductions. I think that's the part that's more confusing a lot of people, is that whenever you normally see an increase in supply and a decrease in demand, your pricing correspondingly drops, right? The cost is maybe holding, but your price of the properties in the housing market would drop. And we're not seeing major declines in price. Now, the contrary argument to that would be, well, you haven't seen any major appreciation in the market either. And if you go back and you look at the appreciation trends over a long period of time, it's not an incorrect read. We haven't had major appreciation for several years. But when you look at where it is versus where we were in 2018 to now, we are still well above our line, but that gap is starting to close. So something to keep an eye on. We want to make sure that we're looking at the market through the lens of it is shifting, and I do think it is cooling. If you know that, though, you can get ahead of it. You don't want to be aggressive in your pricing unless you have nothing to lose, which I think some of these home sellers have nothing to lose. They're like, well, if I don't sell it, I'm going to sit on it. But I think that we have to start having the larger conversation and say, where else is this bleeding out into? What other parts of the market is this now hitting? At first, it was confined to commercial real estate. We're starting to see some cracks in that arena, depending on the type of deal structure and capital stack they put together. I'm seeing more and more instances where they're trying to refinance debt, or when I see a pro forma come through, they've put numbers on there that are highly speculative or highly optimistic that they would be able to refinance debt at a later date, and they're hoping for basically rate compression to happen, and that's just not happening. So on the resale side of the game, I think that a lot of sellers are okay sitting at the moment. They don't need to move. Builders will start to slow down their starts. They will start to slow down the amount of spec inventory they put on the ground. They will slow down land development. I think you're going to start to see the tentacles of this trickle into the rest of the market. And that to me is the real concern. Is it's not just the housing market. It's all the businesses that are attached to the housing market and how that will reverberate through the economy if we let it go too far. And right now, I think we're not in that danger zone yet. Give it another 12 months and you could be there. So we'll keep an eye on everything. Of course, all of this is inside of deepdirt.co. Make sure you guys jump in there. Plenty of tools. There's a free tier. There's a paid tier. We do reports weekly. We do market reads weekly. Love to have you guys come in, ask questions, drop some comments on this video. And if you're not subscribing to the channel, make sure you subscribe, like it, do all this stuff so that you're kept in the loop whenever we have new stuff come out. Appreciate y'all being here, and we'll catch y'all the next time.